Welcome back to another episode of the Beckonomics podcast. I'm Hunter Beck.
And I'm Victor Beck. And we are a couple members of the Beck Capital Management Investment Research team, looking forward to providing continued insights to our audience on the financial world and what's going on with markets.
Remember to give us a follow, like, and subscribe on anywhere you get your podcasts on YouTube, Spotify, Apple Podcasts as well. I think we have a good episode today, something on the mind of a lot of consumers, talking about the housing market and kind of where we're at with that. Victor, you want to lead us into it?
Yeah, so I think anybody who's potentially looking at buying their first home or moving homes is looking at very consciously at the housing market and why prices are so high with interest rates this high. And in order to kind of start this conversation, I want to take a step back, go look a little bit historically and say, how did we get to where we are today? And a huge portion of that is still recovering from the global financial crisis in 2008. Before 2008, you had a lot of government programs, government subsidies that were pushing home building, pushing homes on consumers, getting them into the housing market to own these housing, owning their own homes, because it's always been a huge part of the American dream to own your own home. And I think that's something that's been built into your sense of American economic freedom that has really been appreciated by the American populace. And so going through the global financial crisis, obviously housing prices into the GFC grew pretty substantially. And this was a lot because banks via the government were pushing homes on people, making it very easy to apply, get a mortgage, buy homes that these consumers really couldn't afford. And so when we saw the housing meltdown coming out of 2008, it really led to builders pulling back pretty substantially. Banks were pulling back on lending. And all of a sudden, you didn't have the capacity of building in order to satisfy the demand for all the household formations that were happening within the United States. And so really since 2008, you've had an underproduction of new homes. And that's led to a lot of tightness in the housing market. So you and I, as economic thinkers, we always look at the price level of something is really, at the end of the day, it's a factor of supply and demand. And what we have now is an over demand for homes. We've got a lot of households that have formed in the United States without buying a new home. But we have an undersupply because home builders following the GFC really haven't been building at the capacity that they would like to. Right now, the housing market's extremely tight. I mean, we saw the tightest that the housing market got during this most recent period was in January of 2022, where we only had 1.6 months of supply of homes on the market. And so that's just a measure of how many months would it take to sell all the inventory of homes that are currently on the market. That was 1.6 months. And currently we're still really in a tight labor market, sitting around 3 months supply. What builders, economists really think is fair supply is 5 to 6 months of inventory, which leads to a better balance and can really provide better price discovery for the market. I find this really interesting. A lot of that came out of COVID, and I'd love you to touch on a piece of that.
Yeah. And so like you were saying, GFC and coming out of that, not a whole lot of supply coming online. And then you have all the COVID related issues of messed up supply chains, labor prices, labor and materials prices too. And so everything was really backed up. Construction was difficult. And so you had a low supply and high number of people who are looking to get out of cities, getting into, from apartments in the city to single family homes out in the suburbs. And, that really just that whole shift in dynamic really strained the supply of these homes. And prices boomed, and there's just not enough homes for the number of people buying.
Yeah, I mean, that really exacerbated the problem. I remember the supply of materials was really interesting during the COVID period because a home isn't complete until it's fully finished. I mean, if you're missing one piece of a house, whether it's the shingles on the roof, I remember seeing a bunch of pictures coming out during COVID of full development complexes where the garage doors were just boarded up with plywood because there were no garage doors available. And so at that point, a home isn't truly finished until you have, those major appliances in there, the garage door, the door on its hinges, the tiles on the roof. And so if you're missing a piece of that supply chain, you don't really have a finished house, and nobody wants to move into a house that isn't quite ready to be lived in. And so that just really kept that housing market tight and that inventory tight from that perspective.
Yeah, exactly. And then on top of that, you have the amount of stimulus and financial access to cheap mortgages. Interest rates were zero. Mortgage rates were, high twos, low threes. Just hearing of a 2.9% mortgage these days is just, it's hard to conceive given current rates, but so many people are stuck in these long-term mortgages that were refinanced at next to zero rates. And that's part of the problem that we're seeing today in those golden handcuffs that we've talked about before, and that people don't want to move and give up that super low mortgage rate that they were able to get during this period.
Right. I think that confluence of factors, you mentioned people moving out of the big cities into suburban areas, and then the fact that all of a sudden mortgages were super cheap. You could finance your mortgage 2-3% range. I hope that everybody who owned a home during that period, any of our listeners, was able to refinance their home at those rates, because now you've got an extremely attractive mortgage. I know you and I bought homes a little bit after this period, didn't quite get that kind of rate on ours, but we're lucky enough to get into the market at a time when supply and demand weren't too unnormal. And I think that it's very interesting to see just how tight that housing market has remained. And I think a big piece of that too, that, we've seen in some financial articles, but something that not all of our listeners may be aware of, is the institutional buying that has gone into the housing market that's really been popularized, I'd say, over the last 5 years or so. And that's, you've got these big corporate entities, these investment funds. They realized that they can make money off of buying these single family homes. They were looking at home prices continuing to go up year after year. They thought, hey, we can buy these single family homes and then rent them out to families, because families all of a sudden couldn't afford the homes. And so what they're doing is making really attractive cash flow on these single family homes, but they're also competing with current buyers. So whenever you're competing against a Blackstone or BlackRock or any of these large capital providers, these institutional investors, it's really difficult for your retail person, your consumer, to compete with that level of capital, because their financing's cheaper and you're competing with huge amounts of capital. So I think that really continued to make the problem more difficult for U.S. home buyers.
Yeah, especially when you're talking about an industry where commercial real estate, you're not putting 15-20% down. You're putting a lot more than that. And these huge guys can come in all cash or most cash offers. And there's, individuals can't really compete in the same way as that. And so because those individuals can't really compete in the same way, a statistic that really shows this is that for the longest time it was cheaper to rent or to own than to rent, And ever since 2022, it's now cheaper to rent than it is to own. The prices have gone up so much and stayed there due to those kind of golden handcuffs, high interest rates, that it's still cheaper to rent than to buy for the first time in a very long time.
Yeah, I thought it was really interesting. I saw recently the U.S. Federal Reserve Bank of New York did a survey. And in that survey, they asked homeowners how likely they thought it was that they'd be able to be a home buyer in their lifetime. And 60% of respondents said that they didn't believe that they could potentially own a home, that they'd probably be a renter for life. And I think that just shows how tight the market is right now and where we are in the cycle. And the unfortunate thing is something that we're going to kind of continue talking about, but there's not really a great solution for how to solve this problem. I mean, you could talk about government subsidies, but every time the government subsidizes, whether it's housing or another product, you create issues. It either becomes more expensive or you create create other tightness within some piece of that market. I think incentivizing home building could be, a portion of that, because what we really need is more supply on the market. But it's a really difficult problem to solve.
Yeah, and I think this really leads into our investment thesis on all of this, is that we've been looking at home buyers for a long time, or home builders for a long time, and that trade has continued to make sense, given that these are one of the only sources of new supply on the market. They're making up more percentage of homes for sale, brand new homes are. And these big companies are more readily able to buy down that mortgage rate into something people can rationalize. Oh, you can go get one in the high fives now, rather than looking at a high sixes, low sevens, 30-year fixed. Well, if you can get a 5.99, all of a sudden it sounds a lot more appealing. It sounds like something you could possibly do.
Right. And that goes back to the interest rate conversation. I think what's interesting now, this is a lot more popular in Europe and in Great Britain, but adjustable rate mortgages, something that really became unpopular following the global financial crisis, because what you had was banks putting people in ARM mortgages. And then all of a sudden, once those adjustable rates hit and they couldn't afford that house anymore, many people were walking away. And that was a huge contribution to the housing crash. But we still have about 10% of US mortgages, about 20% of the value of homes in the US under mortgages in adjustable rate mortgages. And so I think that's going to be really interesting to watch over the next couple of years, because what everyone was expecting going into this year, call it late December, was significant cuts by the Federal Reserve. I mean, this all goes back to our Federal Reserve talk that we've been discussing in previous episodes, but a lot of people thought that the Fed was going to cut significantly going into this year and next, 4, 5, maybe 6 cuts this year, similar amount next year. Now we're looking at maybe 2 cuts this year. And so anyone with an adjustable rate mortgage that is hitting that variable price point where they're going to get a hike because they're through that fixed portion of the mortgage is really going to be seeing a little bit of pain when it comes to paying for those mortgage prices. Surveys have shown that that's the number one concern for people with adjustable rate debt, is their debt servicing as far as a financial question mark. And so I think that's going to be something important to watch. You've got 1.4 million mortgages that are adjustable right now, and those are going to continue to hit that variable portion as we go forward.
I think that's an interesting point you brought up about these adjustable rates being much more popular in Europe and Britain, is that, the Fed's policy in the US doesn't translate into the housing market the same way that it does overseas. So they're increasing rates, but that's not affecting most homeowners because they're in 30-year fixed mortgages at low rates. They're not seeing these translate into the economy. So if we had a higher percentage of ARMs, then you would see a little bit more transacting going on in the marketplace. But due to the adjustments made after the GFC, and that hesitance to getting an adjustable rate, a lot of that isn't translating through into the market.
Right. And I hope that the Fed is conscious of this as they go about their policy making, because they have to realize that just because not many U.S. consumers are in adjustable rate mortgages, they're keeping the housing market tight by leaving these rates elevated. Like you said, I mean, new homes are really the primary option for new home buyers, because going back to the golden handcuffs, anybody with a low mortgage rate, 2 to 3% range. I mean, a huge portion of mortgages are under 4% right now. And you're talking about the 30-year mortgage is sitting somewhere around 7%. You're talking about a huge difference in the affordability of housing. I saw that on these adjustable rate mortgages, once those hit those variable levels, it's going to add an average of $1,000 a month to consumer mortgage costs, which is pretty substantial.
Yeah, it really is.
So to finish this thought, I think what you said earlier, looking at the home builders as an investment opportunity really makes a lot of sense right now. That's looking like the best way to play the current tightness in the housing market. just because they're the ones who have the demand. They're able to work that financing and provide those homes at a pretty attractive rate. For those home buyers who are in the market right now, people are tired of waiting to buy a home. And so looking to those home builders in order to accomplish that is really top of line for most consumers looking to buy a home right now.
Yeah, it really is.
And so following from that, I want to thank everybody for listening. Like we said at the beginning of the episode, we're proud to represent Beck Capital Management. Please like, follow, subscribe, Facebook, Instagram, YouTube, anywhere you can get your podcasts. Thanks for listening.